It is a foundational law etched into the mind of every aspiring trader. A clean break of market structure signals a trend reversal. This simple, elegant rule forms the basis of countless strategies, a beacon of logic in the chaos of the market. Yet, this belief is fundamentally flawed. Data from over 10,000 case studies reveals a chilling statistic. More than 70% of these textbook breaks on intraday charts are not reversals at all. They are sophisticated traps, precision engineered to harvest liquidity from those who follow the rules. The very signal traders are taught to trust is, in fact, the trigger for a catastrophic portfolio event. Welcome to the Trade Logic Lab. In this case study, we dissect one of the market's most effective illusions, the false reversal. We will deconstruct, frame by frame, how algorithmic predators use the core principles of price action against the retail trader, turning their logical decisions into the very fuel required for the market's true intention. The analysis does not offer opinion. It presents a clinical examination of a recurring market phenomenon. To understand the trap, one must first understand the bait. Market structure is the market's skeleton, the underlying architecture of price movement. In an uptrend, price creates a sequence of higher highs and higher lows. Each new low is established at a higher price than the last, a clear indication of buying pressure and sustained upward momentum. Conversely, a downtrend is defined by a series of lower highs and lower lows. This rhythm is the market's language, and for a time, it speaks with perfect clarity. Our case study begins at 9:52 in the morning, London time. The uptrend is mature. The structure is unambiguous. Then, the break occurs. The most recent higher low, a critical support level, is violated. For the textbook trader, the logic is immediate and compelling. The sequence of higher lows is broken, therefore the uptrend is compromised. A new downtrend is likely beginning. This single candle is interpreted as a clear, actionable signal to initiate a short position. The response is programmatic. The trader sells the market, anticipating a move lower. A protective stop loss is placed just above the recent swing high, adhering to sound risk management principles. Thousands of traders across the globe, all reading the same chart, all taught the same rules, execute the same trade. A vast pool of buy-stop orders begins to form in a predictable location. This concentration of liquidity is not an accident. It is the objective. But the real power of this apparent reversal is hidden in a dynamic most traders ignore. It is not a reflection of overwhelming selling pressure. It is the result of a calculated, temporary withdrawal of institutional bids. To understand why this strategy fails 90% of the time, we must first examine the flaw in its core logic. The retail trader sees a break of structure and assumes a fundamental shift in market direction. The institutional algorithm, however, sees the creation of a critical resource, fuel. These false breaks are not random events. They are engineered. High-frequency trading algorithms, programmed to hunt for liquidity, can initiate these moves with surgical precision. They do this by pulling their bids from the order book, creating a momentary void that allows price to fall through the structural support with very little selling required. This action is designed for one purpose: to trigger the herd of retail traders into taking the other side. The algorithm needs to buy, but it cannot do so without causing the price to skyrocket. It must first find a massive cluster of willing sellers. The algorithm induces the very signal that retail traders are trained to act on. It paints a picture of weakness. It engineers a textbook break of structure. Every short position taken by a retail trader is a contract to buy back that position at a later time. Their stop loss is a pre-programmed market order to buy. The algorithm is not selling. It is coaxing the market into creating a dense, easily targetable pool of future buy orders exactly where it needs them. The trap is now set. The consolidation after the break is a final, cruel deception. It appears to be a confirmation of the new bearish momentum, drawing in a second wave of sellers and adding even more liquidity to the buy-stop pool above. The retail traders believe they are in control, having correctly identified a shift in the trend. In reality, they have been maneuvered into becoming the counterparty for a massive institutional player. Their collective stop losses are no longer a defensive measure. They are the primary target. The algorithm's objective was never to initiate a downtrend. It was to accumulate a large, long position at a favorable price. And now, it begins the second and most violent phase of its operation. The reversal is not gradual. It is instantaneous. A violent repricing event that erases the entire down move in a single, explosive candle. There is no hesitation, no pullback. It is the release of immense, coiled pressure. The algorithm, having now induced sufficient sell-side liquidity, ceases its manipulation and reveals its true intention. It unleashes its core buy order. The price rockets upward, directly toward the dense pool of buy stops placed by the trapped short sellers. This is the sweep. The stop-loss orders are triggered in a cascading wave, forcing the short sellers to buy back their positions at a loss. This cascade of forced buying creates a feedback loop, pouring gasoline on the fire and propelling the price even higher with breathtaking velocity. The primary uptrend reasserts its dominance with brutal, unforgiving efficiency. The chart now shows a catastrophic failure for those who followed the textbook rule. Their logic was sound, their signal was clear, yet their accounts are decimated. The question is not if this will happen again, but how to identify the subtle fingerprints the algorithm leaves behind before the trap is sprung. The first clue is hidden not in the break itself, but in the character of the price action leading up to it. The first clue is hidden not in the break itself, but in the character of the price action leading up to it. Healthy, sustainable trends move with purpose. They expand and contract with a certain rhythm. But before an engineered liquidity hunt, this rhythm changes. The price action becomes corrective, overlapping, and compressive. It struggles to make new highs, each upward push weaker than the last. This is not a sign of the trend dying of natural causes. It is a sign of sophisticated accumulation. The algorithm is quietly absorbing the last wave of optimistic retail buyers, while simultaneously building its core position without tipping its hand. It allows the price to drift just high enough to keep the illusion of an uptrend alive, all while preventing any real, powerful breakout that would attract unwanted attention. But what if I told you that trapping the retail herd was only the secondary objective? What if this entire, elaborate deception, this perfectly painted chart, this textbook failure, was merely a feint, a smokescreen for a much larger, more dangerous game? You see, the market isn't a battle between a single, all-powerful institution and a million small traders. It is a perpetual, invisible war between competing institutions. Each algorithm is designed not only to hunt for retail liquidity, but to outmaneuver, trap, and consume its rivals. The retail stop-loss pool, that wasn't the target. It was the bait. The first algorithm, let's call it Predator A, knows its rival, Predator B, is also in the market. It knows Predator B's own algorithms are programmed to identify and trade strong momentum breakouts. So Predator A doesn't just engineer a trap for retail. It engineers a signal for its true opponent. The violent cascade of retail stops being triggered creates the exact signature of a high-conviction breakout. It's an explosion of volume and velocity that, to any other machine, looks like the beginning of a major leg up. Predator B takes the bait. It jumps into the market with immense size, seeking to ride the wave, and in that precise moment, the trap's true jaws snap shut. Predator A uses the buying frenzy it created to exit its own position at a massive profit, selling its inventory to its trapped rival. The market you thought you were trading is a lie. You are not a participant in a game of patterns and probabilities. You are the ammunition in an unseen war between silent, computational gods. But what if even that isn't the whole truth? What if this war between gods has its own predictable rhythm, a pulse, and if you can learn to feel that pulse, you stop being the ammunition, and you become the ghost in the machine. So how do you do it? You stop looking at the chart as a two-dimensional space of price and time. You start seeing it as a recurring echo. What if I told you the war between Predator-A and Predator-B wasn't a unique event? What if it was just the latest, loudest performance of a play that has been staged 1,000 times before? This is the market's hidden pulse, a temporal fingerprint. These algorithmic battles are not random. They are cyclical. They are drawn to specific temporal liquidity zones. Not just a price where stops are clustered, but a moment in time where the system is inherently vulnerable. The ghost in the machine doesn't try to outtrade the algorithm. He outweights it. He knows the rhythm. But why does this happen? Is the entire market just one big looping program? Or is it something deeper? A kind of emergent, structural memory? The truth is both simpler and more disturbing. The algorithms are designed for efficiency, and the most efficient way to hunt is to return to the grounds where you've successfully hunted before. They are conditioned, they remember, they learn, and they repeat what works. So the trap you fell for today wasn't designed for you. It was a refinement, a perfected version of a trap that worked last quarter, and the quarter before that. You weren't just fighting an algorithm. You were fighting the ghost of every trader who ever made your exact mistake. The machine is running a script. Your role, the retail counterparty, was already cast before you even opened the chart. So how do you break the loop? You start by recognizing that the setup isn't just the pattern on the screen. It's the entire information ecosystem. The algorithms don't just manipulate price. They piggyback on human psychology. Think about it. When do these traps most often occur? Right after a major news event, when a specific narrative has been hammered into the public consciousness. The narrative creates the herd. The herd creates the liquidity pool. The algorithm simply provides the catalyst. It is a full-spectrum operation. The war isn't just fought on the order book. It's fought in your mind, using the headlines you read as its primary weapon. But if the machine can learn from the past, so can you. If you can identify the rhythm, if you can spot the narrative being woven, you are no longer the target. You are an observer. But what if there's a flaw in their memory? A glitch in the echo? What if the very act of them repeating their most successful hunts creates a new, predictable vulnerability for an even higher level predator? This higher level predator is you, the human mind, capable of seeing not just the pattern, but the pattern of the pattern. The algorithm's perfection is its flaw. Its memory is so flawless, its repetition so precise, that the hunt itself becomes the ultimate tell. You are no longer looking for a price level to trade. You are looking for a signature in time, an energetic anomaly. You're hunting the hunter. This is the third layer of the game. The retail trader sees a pattern. The algorithm sees the retail trader. But the ghost in the machine sees the algorithm. They don't get lured into the breakout. They don't get caught in the reversal. They operate on a different plane of logic. They know the script. They know the actors. And they know precisely when the curtain is about to rise. They place their orders not based on what the price is doing, but on what they know the algorithms are about to do. They position themselves at the terminus, the point where the machine's perfectly replicated plan is designed to cause the most panic. They are not catching a falling knife. They are placing a net where they know an object is programmed to fall. They use the algorithm's own predictable force to enter the market with surgical precision. The market is not a field of battle. It is an engine, a complex, layered machine built of code, fear, and greed. And every engine has an operating manual. Your job isn't to be a better soldier in the war. Your job is to become the mechanic, to understand the logic, to read the schematics, and to know the machine so well that its roars and tremors tell you everything you need to know. The game is deep, but it is not unknowable. The logic can be learned. The patterns can be deciphered. Here at trade_logic_lab, we don't just give you the plays. We hand you the playbook. We're here to teach you how to become the mechanic. Subscribe and learn to read the